In this episode, I discuss why it is so important to start using your infinite banking policies. I'm Nate. I make sense out of money. This is Dollars and Nonsense. If you follow the herd, you will be slaughtered. Well, I have been having a change of heart lately, and you are about to hear for the first time Nate's subtle change of heart that's been honestly bubbling below the surface in my own IBC life and in, my recommendations to clients for probably a year or two now. And I think I have been recommending people not use policies in certain situations when in reality, I feel like I've been making some mistakes. I've been having a change of heart. I believe that all of us should be using policies more than we have been. And that's going to be the whole purpose of this show. And just a kick in the seat of the pants to say if you are wanting to become your own banker, you need to start using your policies. And if you don't have any policies yet, and you're listening to this and trying to figure out who to work with, and if you really want to do this and so forth, I think this episode will be very helpful. And when you do get started, to just get to work as a banker. So I think we need to be using policies more and more. And some of this has spawned because of a couple of things. Let's go ahead and dive in. Lately, I get asked by clients all the time, especially new clients that are just starting out, where they've got some expenses coming up. And it's a very common question for them to ask me, Nate, should I use my brand new policy to fund whatever it is that's coming down the pike? Maybe it's like going on a vacation. It's going to cost $10,000 or $15,000. Maybe it's going to be a bathroom remodel. Maybe it's going to be, various projects that people are going to have. And what I'm trying to point the finger at right here is that most of these things are expenses coming up in which the client has actually been setting money aside to accomplish that anyway. So they come to me to paint the story. They have a new policy. They're wanting to use it. They believe they should use it. And they've also got the cash in order to pay for the thing. It's already set aside. Maybe it's $10,000 to go on vacation. We're like, we already have the money to go on the vacation. And in the past, up until very, very recently, within the last couple of weeks where I've devoted myself to make this change, I have told people what to do based on the mathematical, logical conclusion. And I'm having a change of heart. Let's dive into this. Here's how I've changed, or here's how I've normally responded, and here's how I think I'm going to change. Normally, the recommendation would be, they come to me and they say, Nate, let's say it's going to be a vacation. It's going to be $10,000. We're going to go on vacation. And the normal response would be, guys, it really doesn't make a lot of sense, and think it through with me, to use a policy to fund the vacation that you already have cash set aside to do. Because let's play this out. Let's say we went ahead and borrowed $10,000 from the policy, and we spent it on the vacation, and you have $10,000 left sitting in the bank. The reason why I've typically said it doesn't really make a lot of sense is because the next logical progression for us would be to say, well, the $10,000 that's sitting in the bank, we really don't want it there. Isn't that the whole reason that we're doing this becoming your own banker strategy, is to get rid of banks as much as we can, whether we're borrowing from them and needing to pay them off, or whether that's in our own deposits. We don't want business with banks because it doesn't profit us. We would rather do it with our own bank. That's kind of a fundamental philosophy that we're all dealing with, and it's true. So with that being the case, the logical progression would be, well, why don't we just put that cash in the bank account back in the policy? Isn't that where we want it to be anyway? So then what would have happened is you would have taken a policy loan out, gone on vacation, and then immediately just put the cash back in the policy. We'd be right back where we were. We haven't gained anything with that little transaction. It hadn't pushed forward your system at all, and we would have paid a little bit of loan interest on the policy loan. What was the point of all that? And so historically speaking, I've said, no, it doesn't make a lot of sense. And so then what I've been trying to do, relatively unsuccessfully, I might add, and this is the whole point of this podcast, what I've tried to do is to teach those clients that it's not like it will never make sense to use a policy to go on a vacation or to remodel the bathroom or to do all these sorts of things. It only doesn't make sense because you are not set up correctly yet. That's the idea. You're not set up correctly yet. You still have so much reliance on the old way of doing things, with building up money in bank accounts and spending it for things we're doing in life and paying cash for all sorts of things. That's how you've been doing it for 30, 40, 50, 60 years. And it's not like we're just going to immediately change that. And so the idea would be, as we progress forward, to start moving capital out of bank steadily over a period of time. And so into the future, maybe 2-3 years down the road, you wouldn't really have the $10,000 for the bathroom remodel or for the vacation or whatever it is sitting in cash. It would be in the policy already. There wouldn't be the cash in the bank. We would have paid premiums. We would have moved it in over time. And so then the more that becomes a reality, the more it makes sense to use policies for everything. It depends on where the money's at. IBC starts to make more logical sense when your life is built that way, which is why I've said in the past a couple of things that I'm going to get into later about the 4 stages of IBC, which I'm really on a kick, and I think it makes all of this wrapped up really nicely in a very sensible, logical manner, that IBC really wants to be practiced at a stage 3 or stage 4 level in most people's lives. That's what it wants, and that's where everything makes sense. Trying to do stage 3 or stage 4 transactions when you're actually in stage 1 or stage 2 of IBC, it gets all wonky. You start running into this thing that I'm bringing up right now, where it's like, hey, I feel like I should be using my policy to do this, but Nate says it doesn't really make a lot of sense because if we borrowed money from the policy to go on this vacation, then really probably the plan might be just to send the money right back into the policy because I have the cash and I don't want cash. I want cash value, not cash. And so here is where the change of heart is happening. I am now, after I just went through 5 minutes to explain why it may not always make sense to do that, I am now changing my mind because I have seen people, or I've seen that my suggestion right there be relatively unsuccessful. Not with everyone, but with some people, is that the idea would be they will never get comfortable enough with their system if they never use it. And here is where the rubber hits the road. I've been so focused on teaching people what makes mathematical sense every time objectively, trying to come down to that conclusion. And yet I still find that they are actually making decisions moving into the future about their IBC system that don't make sense. Mainly, it's the opposite version of what I just said. In other words, they never get enough comfortability with the system, with funding and capitalizing policies, that they will never get to the point where they have situated themselves to be able to fund vacations. That's like a stage 3, stage 4 style mentality. They are thinking it in their head, I want to be there, but their confidence level remains subdued. And so the truth behind it, and what I am starting to fully dive into, is that passivity is the ultimate enemy of success. Passivity is the ultimate enemy of success. If you don't start using your policies, you will never become a successful IBC'er. Nate has tried to tell people that before you start using it for certain things, you need to make sure the entire system is big enough in your life to handle it. But now I'm realizing what Nelson Nash taught, what Ray Poteet taught, what some of these people were trying to get across to people. You'll never get to stage 3 or stage 4 because what stands in the way is fears and concerns and anxieties that can only be overcome through use. This is why you could also call the episode title today, Passivity is the Ultimate Enemy of Success. And I wanted to share an example not from the IBC world, but from just the finance world with Dave Ramsey. I've brought him up before. I've actually said these types of things like him before. Dave Ramsey's financial suggestions to people often are mathematically, objectively incorrect. And I've said this before. And I've been on a kick like this on many different fronts by recommending to people that objectivity can go out the window when you deal with human beings who are flawed. And so let's dive into this. So Dave Ramsey, he is promoting things that, as I brought up, don't actually make mathematical sense. But the whole foundation of his recommendations is essentially the same thing what I'm recommending today, which is passivity is the ultimate enemy of success. And so it actually no longer matters if something doesn't make sense. What matters is that you take action. And we've said this before many times, this idea that it's far easier to steer a ship when it's not docked in the harbor. You can't steer a ship that's not moving at all. We can make course corrections if we will take action and start moving. Far easier to steer a ship that's out at sea than one that's sitting at the dock. And that, I think, is essentially all of Dave Ramsey's suggestions. Let's take an idea for that. So Dave Ramsey will say things like, and I've actually mentioned these in episodes recently, like cut up your credit cards. As I've said, that doesn't make any sense. I make probably $1,000 to $2,000 to $3,000, I don't know, a lot of money on rewards using a credit card to buy things I was going to buy anyway. Why would I cut these up? It doesn't make sense. Of course, it may make sense to people who are very, very poor with money, and that's, of course, his target audience. But what he's saying is people who are struggling with money, they should cut up their credit cards because math no longer makes sense. Or math is not the reason why. They are in credit card debt, not because they looked at it objectively with math at the forefront. They did it because of the human issues that plague us all, decisions that we made that maybe we would regret later. And as I brought up recently, he was in a meeting with Ben Shapiro talking about this. You know, Dave Ramsey says that you should pay off, if you're getting out of debt, you should pay off the debts with the lowest balance first and the highest balance later, and actually don't even care about interest rates. And Ben mentions to him, you know, if you looked at just math, really people should target the highest interest rate first, not the lowest balance first, because that's actually going to help them pay off debt quicker than your method, Dave. And Dave says, of course I agree, I understand how math works, but the people did not find themselves in this situation because of math. And math's not going to help them get out. And so this is the idea, is that many of his suggestions are not actually math-based. They're people-based. They're human faults-based. They're human faults-based. So same thing goes with what his desire for people to be completely out of debt and actually to be extremely debt-adverse. He's very disdainful towards debt. He hates debt of all sorts. Where, of course, many of us listening on this show would say not all debt is bad debt. Of course. Some debt is useful. Some debt makes sense. Back whenever you could borrow at 3.5% to buy commercial property and residential real estate, I say we use some of the bank's money. It's extremely cheap to use their money. I think we should use it. Makes sense. And that goes deeper whenever he mentions that not only should you be so debt adverse, you should get a 15-year mortgage, not a 30-year mortgage. And not only that, you should pay it off quickly. You should pay it off rapidly with extra principal to get out of debt. That was not a mathematically sound idea. But here's the idea. Dave Ramsey has this huge following of people who've fallen in love with him because they started to take action financially and seeing measures of success, and they are excited about their future because they took action, even if the things they were doing didn't exactly make mathematical sense, but they adopted his paradigm of life and it's making sense. I believe that IBC is very logical, very mathematical, and is objectively extraordinarily sound, more so than anyone around can even get credit for, and more so than I want to talk about in this episode right now. But what I'm saying is I'm starting to realize this about all of us. I've seen it in my own life, that for years I was so, as I was getting into IBC, doing it full-time, teaching people how to do it, I was so focused on making sure I only used policy loans to do things that made perfect sense. And here's where I'm changing. I believe, and I'm going to talk about this in a moment too, but I believe that you should use policies for things that you should be using policies to do, even if your system isn't quite at the proper stage yet. You likely won't get comfortable enough with the system. You won't get to the proper stage because of your comfortability if you don't use it. And so I wanted to bring up that idea within the 4 stages of IBC concept. So for those of you who didn't listen to the podcast, it's episode 160. There's also on our website, maybe we'll put a link in the show notes as well, to the 4 stages webinar. I've been encouraging people to watch this. I think it's vitally important to your understanding of how and when and where to use policies and how it should fit into your life. There's nothing better in the world than watching the 4 stages webinar. That's not even my opinion. That's everyone who's ever watched it. So go watch the webinar. Very well done. And I would say that whether I created it or not. But to do a quick review, there's essentially 4 very distinct stages that you can practice infinite banking within. There's 4 very distinct stages. The characteristics of your system will be dependent on which stage you find yourself in. So there's the stage 1 is called the saver stage. Stage 2 is the capital builder stage. Stage 3 is the entrepreneur stage. And stage 4 is the lifestyle stage. And each stage has its very own characteristics. And IBC it's supposed to look different. The logical IBC transactions that you do look different in every stage. And so oftentimes, what actually occurs within this idea of the 4 stages really is that most people envision IBC happening in stage 3 or stage 4, but they can never get there because of a few issues. So let's go ahead and dive into a quick review, and then I'm going to tie it into the message I'm preaching today, which is a little bit different than the message I was preaching just a few months ago inside of the stages. So in stage 1, the saver stage, normally within that stage 1, you're mainly saving money into a policy. Oftentimes it's money that was already liquid. It was already cash, money that was already in the bank. Maybe you're moving in emergency funds, or maybe you're just diversifying some money, like you've got some money in stocks and bonds and real estate. You're just like, I'm gonna put a little money in here. You're just trying to save a little bit of money into a policy. In the saver stage, it rarely ever makes logical sense to use the policy because it's a very small piece of your overall picture. So inside of the saver stage, a lot of times you'll get started at a low level of premium. By the way, that's another good key point that I forgot to mention at the very beginning, that in the 4 stages, what actually puts you in each stage is not what you're doing with it. It's how much premium, how much capital you're contributing to the system based on or compared to your capacity. So all of us have a max capacity to contribute to policies. You don't have to contribute your max capacity, but all of us have a max capacity. If you contributed max capacity to policies, it would put you in the stage 3 and stage 4 environment.
The conventional financial system makes the bank rich using your money and pays you next to nothing in return. At Living Wealth, we believe in challenging the status quo. After all, most of those conventional tools only seem to make someone else rich. Let us show you how to become your own bank. Visit livingwealth.com/bank on yourself. You'll receive instant access to what we call the beginner's course. This free, in-depth, easy-to-follow course teaches people how to create and profit from infinite banking. We not only discuss the philosophy and principles behind infinite banking, but also offer real-life examples to demonstrate how it works. Even participants experienced with infinite banking often tell us how they learned a ton too. It's worthwhile regardless of your experience level. Stop letting the banks and Wall Street dictate your financial future. Again, that's livingwealth.com/bank on yourself to gain access to the free course today. Now back to Nate and Holly.
And so what puts you in the stage 1 is just you're not putting very much capital into the bank compared to what you could be at a higher level of IBC. That's the idea. So that's what's putting you here. Low levels of premium compared to what you could be putting in. Inside of the saver stage, there's often no intentionality. Like, we're just saving money. We did not, in our mind's eye, have an actual use for the policy once it's open. We thought maybe we'd use it, maybe we wouldn't, but we'll just see what happens. We know it's there. We're saving some money. Maybe I'll use it in the future, but there wasn't exactly any sort of intentionality in the saver stage, which is why we've said, historically speaking, those of you who are in the saver stage of comfort level, using the policy may not make mathematical sense. And that's why I was bringing up in the in that episode that you run into this idea where like, hey, I've got some money in a policy. Nate, should I use the policy to go fund vacation, or should I use this gigantic pool of money in cash that I have that's never found its way into the system? Historically speaking, I would say, well, why would we use the policy? The logical progression would be that you would borrow money from the policy, pay for the vacation, and still be left with a whole bunch of cash in your checking account. That's what we're trying to solve for. So my recommendation historically would say, no, don't use the policy to go on vacation this time. Go and use the cash, but correct the problem. Correct the problem. The problem is the cash in the bank. So move all that money into policies. Get into stage 2, my friend. Put more money into premium so that you have higher amounts of cash value and less amounts of cash in a bank account. And then the next year, when your vacation rolls around, we won't even have this question, because you won't have money sitting around in a checking account. You'll have money in cash value and policies. So of course we're going to use it. That's the idea, that as you increase premium levels to move money into the system, you start moving from one stage to the next. And as you go down the stages, you start using your policy more often by default. That's the key. And so the idea is, anytime you use a policy by default, in other words, it's the only option you have. Like we're of course we're going to use our policy. That's where all of our money is. We don't have money in the bank to go do it because we've moved it all into the policy. The more transactions you can use a policy to do by default, those are the ones that always make mathematical and logical sense. It's the times where it's not really the default, where you've got money on the side where it hasn't made mathematical sense. And what I am changing in my heart is that I've now realized people will not move from stage 1 to stage 2 if they never use their policy. They never will. Same thing for stage 2 to stage 3. All the transactions that make sense in stage 3 that might not make sense yet in stage 2 because they haven't committed to a high enough premium level based on their capacity, they'll never move unless they start using the policy. It's a human error, not a math error. The math is actually telling you to move into the next stage. The human error is what's causing people to stay in their default mechanism of banking apart from policies. The only way, and we're going to talk more about that in just a second too, in Nelson Nash's own words. So the saver stage is where a lot of people will find themselves in. It doesn't make maybe mathematical sense because we just haven't moved very much money in compared to our capacity to have moved money in the saver stage. You should start using the policy though. I'm changing my mind. Let's use it. In other words, if it makes sense to do something, if you should be using your policies to do whatever it is, then let's go ahead and use it even if we're not in the stage yet. We will then figure out as time goes on what to do with the cash that should be in the system. Hint, hint. It should be capital contributions to your bank. How do you make capital contributions to your bank? Through the premium mechanisms of either new policies or paid-up additional rider premiums or something. So that's stage 1. Stage 2, the capital builder stage, is really just kind of taking the next step. It's saying I'm going to contribute more money to policies, and I'm going to start, oftentimes in stage 2, we start to contribute money with some intentionality. We're thinking to ourselves, I do go on vacations. I do occasionally do home remodels. I do finance cars. I do all these different things, and I want to start financing all of these things from my banking system. So you start redirecting more cash flow with intention to start using it. And so now in stage 2, more transactions to be used from the policy will make sense compared to what it was back in stage 1. Why? Why does using policies more often in stage 2 make sense compared to stage 1? It's because more of your capital, of your banking system, is inside of policies and less of it is going through banks. And that was by your intention. You funded at a higher level to allow yourself to take advantage of policies more often and banks less often. So we start adding more transactions to it. Remodels, car purchases, maybe kids' education, a few investment opportunities, maybe paying down debt. We've had a focused intention to do it. We start building real capital into the system. Things start to make more sense. And then the same thing, entrepreneur just takes that to its fullest position. And that is, we call it the entrepreneur stage. Stage 3 is the entrepreneur stage because we start operating it like a banking business. In the entrepreneur stage, every dollar of free cash flow, every dollar that's not going to be spent in your life on just basic, on your lifestyle. I don't even mean to say the word basic. I really just mean on your lifestyle expenses, is going into premium first. And if every dollar of free cash flow is going into premium first, you of course will be using your policy quite often, and it's going to be logical, it's going to make sense, it's going to become the default option. You're going to default to using policies more often by design. And that's where IBC wants to be. It takes a paradigm shift to get out of stage 1 and 2 and into stage 3 and to stage 4. The stage 4 is the lifestyle stage where now we actually are redirecting money that is going to be spent, not just free cash flow, but money that's going to be spent into policies. That one takes a lot more planning and consulting from someone like me to determine if it even makes sense to get there because some people it doesn't. It's more complex, it's more strategic. I'm not going to go into the details fully inside of the lifestyle stage in this episode right now. Go watch the webinar. We'll go into details of every stage, and we show a real life scenario of what it looks like to be in every stage with real numbers inside of that 4 stages webinar. I think you'll love it. So with that being said, in every stage, there are things to use policies to do that make logical sense. And I have kind of shied away from encouraging people in stage 1 and stage 2 to do stage 3 and stage 4 transactions because maybe on paper, we're like, it doesn't really make sense. You're not in the right stage. You haven't committed to the system enough to start doing those types of things. There's money in the bank, still not in your own bank. There's money in like a bank account, like a checking account, that's never been contributed as capital to your own system. So we may just not be using it as much because it doesn't make a lot of logical sense. If you don't start to use your system, you will never grow comfortable enough to get there. The same thing why Dave Ramsey offers recommendations to people that don't actually make logical sense, but it's because it's part of the new paradigm of living under his umbrella. And he's saying, hey, I don't care if it makes sense or not. I'm trying to help people achieve success. They have to take action. They have to take action. I wanted to read from you. I'm going to pull up Nelson Nash's book really quick. Nelson Nash's book, by the way, if you haven't read it, Nelson Nash's book, Becoming Your Own Banker, you got to get it. You got to get it. It's the Bible of banking. In Nelson Nash's book on page 35, the use it or lose it section. The use it or lose it section. This is what Nelson has to say about using the system. He describes accepting a totally new point of reference means that one must develop new habits. This is absolutely true. I feel like I missed it. If you are going to accept a totally new point of reference, you must develop new habits. Absolutely true. No question. If you want to create a banking system and live your life under the new paradigm of owning and operating a banking system, the only way to do it is to accept a totally new point of reference. You must develop new habits to accept the new point of reference. It requires a paradigm shift. Just like he said, and a little bit later, he says, the infinite banking concept must become a way of life. You must use it or lose it. I can't agree more. I missed it. I did not fully grasp that it is impossible to make this a new way of life. In other words, what I used to say is this will become a way of life once you commit to stage 3 and stage 4. Like once you get to those stages of premium paying based on your capacity, then it will become a way of life by default, and that's when it makes mathematical sense. I'm changing my mind. I don't think most people can get to stage 3 or stage 4 unless they start making it a way of life while they're in stage 1 and stage 2. And that will help them become like a stage 3 practitioner, the entrepreneur, where they're operating this. The stage 3, they're operating it like a business, is why it's called the entrepreneur stage. And oftentimes in that world, you have to have switched a paradigm. What keeps people stuck in stage 1 and stage 2 is fear of premium. It's fear of the system. It's fear of the unknown. Oftentimes it's concerns that there are valid concerns about expanding the system and getting, biting off more than you can chew. There are some valid concerns. Most people don't have valid concerns. Most people have invalid concerns based on misclassifications of policy transactions, which we've talked about, based on fears of just ignorance and different things that can produce fear, of course. Ray Poteet, my mentor, he passed away on March 10th of this year, March 10th, 2023. Many of you probably heard about that. Passed away in an accident. I'm not going to go into a lot of details. It's still fresh. And to avoid crying on the episode, I'm going to avoid getting too sentimental. I will tell you one thing, though. Ray made infinite banking a way of life to the point where I don't know if there was anyone in the IBC community who did what Ray did. From 2001 to 2023, he was an infinite banking pioneer, and it was truly, he had completely and totally adopted over that time a way of life, and he was an incredibly successful banker. Holly and I may decide, depending on how we're feeling here in the near future, to shoot an episode where we discuss what did his system look like, what has passed on to the next generation. For someone to see the magnitude of what IBC can be over a life lived, fully adopted in the new paradigm. And what I'm saying is, he was never afraid to use policies. He used it for everything. Even if I would have told him, hey, Ray, there's cash in your bank account right now that really needs to get into the system. Maybe you should just use that instead of a policy. No way. Because the final point, and I've already mentioned it before, is that he was a firm believer in this. I'm better maybe at wordsmithing. Like, I'm better at describing how he lived, and better maybe than he could say in a sentence. I'm just saying this is how he lived. We should use policies to do things that it makes sense to use policies to do, period. If you happen to have money in the bank, if it happens to not actually make mathematical sense at the time, it's not the policy's fault that it doesn't make sense. It's your fault because you haven't built the system correctly yet. Use the policies. Take the cash that is now freed up that you're not going to spend and start to expand the system so that it will start to make sense, and so you can get to the proper stage that you want to be at in IBC. That's fundamentally how he lived his life. We would borrow money to do things inside of Living Wealth. Like, we would go buy a new copier system and paperless system and so forth. It's going to be kind of expensive to do that. And maybe Living Wealth at the time had money in the bank. No way are we using the money in the bank. No way. What are we going to do? We're going to lend money from our policies to the Living Wealth, the company, to purchase that. And the Living Wealth's going to pay us back over time. No way are we not using the system to do this. The problem was not the system. The problem was that why did we have money to in the first place? That was our mistake. We're going to get that money out. We're going to put it into our policies so that next time that doesn't end up happening. By the way, as I brought up, using policies always makes sense when they are the default option. They become the default option when you've done a good enough job transitioning out of banking the way we used to do it, with Bank of America and Wells Fargo as the leader. It becomes the default when you're in stage 3, stage 4, IBC, and the most transactions are defaulted beyond just basic lifestyle expenses and so forth, which we can choose to do, we can choose not to do, but those maybe still operate through a checking account. But besides that, we want as many things as we can to be financed from policies. And let's just go do it. This was the kick this was a big deal to me. I'm going to change how I'm operating. I'm encouraging you to change how you're operating. I believe passivity is the ultimate enemy of success. If you don't use it, you will lose it. As Nelson Nash says, to adopt this new paradigm, you have to form new habits. If you never form new habits, you will not adopt the new paradigm. Let's get to work. Let's use policies. Let's get excited about what IBC can be. Let's get excited about what becoming your own banker is. The freedom, the control that you can have by building this financial system is unmatched anywhere. What you can accomplish when you have successfully implemented IBC, that's why it's called infinite. There's no end to what you may end up doing with your policies once they are properly funded. Let's get to work funding them. Let's start using them. Let's have a fun time doing it. Let's rock and roll. This has been Dollars and Nonsense. If you follow the herd, you will be slaughtered.
One last thing before we go. Start your journey towards financial security and wealth today. Visit livingwealth.com/bank on yourself. Upon completing the course, you'll have all the information you'll need to see if infinite banking is right for you. Again, go to livingwealth.com/bank on yourself.